So there are three things then. You're in the top 10%, you have success, previous success, and you have money. And guess what that ends up as? That ends up as over 90% failure. In fact, the average trader coming into the market is blown out in a little bit more than 3 months. If we can understand this, then we can go a long way in understanding how to make money in the markets and how to trade the markets.
Most people believe that if you're smart, successful, and have money, you're automatically equipped to win in the markets. But as Bill Williams just made clear, that's exactly what leads most traders to fail. In this first part of his groundbreaking lecture, Bill breaks down why traditional approaches to trading don't work and what actually does. From redefining the market itself to exposing the mental traps that sabotage even the smartest investors. This session will challenge everything you think you know about trading. Let's get into it.
All right. Thank you. We're here today to talk about trading and some ways to increase our efficiency at trading and make more money at trading. One of the things I'd like to pose with you first is a real problem that we have in trading. And if we can solve this problem, then we're a long way along the way to understanding the market better and to trading better. One of the first part of this problem is that you as a group of traders are in the top 10% intelligence-wise of the entire nation. We're in the top category as a group. That doesn't mean that every one of us is in there, but as a group we're in the top 10 percentile. Most of the people who come to trading commodities have already been successful, and that's the second characteristic of it. And that's number two, is that we've had previous success. And then the third thing that we have, yes, okay, yeah, we'll lower those so you can see them better. The third thing that we have, unless you have found a broker that I haven't found yet who will open up an account on a credit card, you have to have accumulated some kind of amount of money. So there are three things then. You're in the top 10%, you have success, previous success, and you have money. And guess what that ends up as? That ends up as over 90% failure. In fact, the average trader coming into the market is blown out in a little bit more than 3 months. If we can understand this, then we can go a long way in understanding how to make money in the markets and how to trade the markets. Albert Einstein, toward the end of his life, was asked a question by fellow scientists. And the question that he was asked is, what is the most important question we could possibly ask? And they thought that Einstein was going to say that something about the unified field theory, which was what he was working on at that particular time. But his answer is intriguing. Without any hesitation, he said the most important question you can ever ask is the universe a friendly place? And today the question I hope we can ask after this is over is the market a friendly place? Let me give you a challenge right now. You have your pencils and paper there. What I'd like for you to do is to take a second or two and write down on that piece of paper what animal personifies the market to you. Assume that I have just landed from Mars. I don't know anything about the market, but I want to become a commodities trader, and I come to you and I say, well, what is it like? You know, I know animals. I've been out on the farm. What animal does the market personify to you? Okay? Somebody give me an answer.
500-pound gorilla.
A 500-pound gorilla, okay? A wolf. An eagle, okay? Godzilla. What else?
A female.
A female. Whoa, I won't get into that one. Okay, what else? Anybody have a different one? A cow. A Tasmanian devil. What's characteristic about all of this? Unpredictable, unfriendly. Exactly. It's unfriendly. It's threatening. And we come to the market, and this is a threatening thing, and we're supposed to relax and make money and trade well. And one of the problems that we have is that in trading the market, we oftentimes come in with a lot of fear. And because we have that fear, our mind doesn't quite work the way it should, and we don't trade the market the way it should. Today we're going to look at a very different map, a very different way of looking at the market. And the first thing we need to understand is exactly what is the market. It's not a Tasmanian devil, it's not Godzilla, it's not a female, it's really not all these things. The market is very simple. And I'd like to share with you a very simplistic kind of a comic book example of what the market really is. Most of you remember the Flintstones. Remember, we had two leading characters in there. We had Fred, and the other guy's name was Barney. And Fred was sort of an outgoing guy, a dinosaur hunter, and a real He-Man. And Barney was more the academic, laid-back research guy who likes to live in his backyard. And Barney liked to carve dinosaur clubs. And Fred likes to go out and hunt dinosaurs. So one day, Fred goes out, he really hits the jackpot, he brings home 2 dinosaurs, and he's dressed those dinosaurs, and he's got all these dinosaur whoppers in his freezer. And he notices that his club is kind of wearing out. It's not too good. And he looks over at his neighbor's yard, Barney, and Barney's got this brand new club. So Fred gets an idea. And he goes over to the fence and he says, Barney, I tell you what I'll do. I'll give you 2 big platters of dinosaur whoppers if you'll give me that club. And Fred thinks about it, and he thinks, well, if I get those 2 platters of dinosaur whoppers, I won't have to go hunting for a couple of 3 weeks. I'll feed my family, everything. Okay, Fred, you've got a deal. Now, they have created a commodities market. And there's no commodities market in the entire world that's really more complicated than that. They have a lot more computers, a lot more screens than Fred and Barney had, but that's a commodity market. A commodity market, very simply, is a process or a place that's designed specifically to find that point where there's an equal disagreement of value and an agreement on price. For example, the last car that you bought, you gave somebody either your money or your credit to get the car because that car was more important to you than that money. Now, to the other side of that deal, your money was more important to the person you bought the car from, and you made a deal, and you created a commodity market. And again, repeating that, a commodity market is nothing more, any market is nothing more than a place where you have your job is to find that place where there's an equal disagreement on value and an agreement on price. Now, that being true, let's examine that and see if we can take it a little bit further. If that is true, we can greatly simplify our approach to the market. Making money, and you've heard this before, making money in the markets is really very simple. Not necessarily easy, but simple. And commodity markets are very simple. Now, as a commodity market, and they're very efficient. I mean, they find this place, whether it's outcry or computer matching or whatever, before you know it, before I know it, before the guys and gals on the floor know it. It happens automatically. It will be right at that point all the time. If that's true, then we can throw out a lot of things. First thing we can throw out is the concept of bullish and bearish consensus, because basically there is no such thing. The way that works is simply this. I will go out and I will survey some people. I'll survey these 4 people over here. What's your opinion on gold? You like it, you like it, you like it, you don't like it. Then I write up a text and it says that there is a 75% bullishness in gold. Now, all that means is I haven't surveyed all the bears, because there can't be 75%. There can't be 50.1% bullishness in the gold. If there were, it would have already gone up in price. So if we can throw out bullish and bearish consensus, we can throw out some other things. We can throw out the entire concept of oversold, overbought, because it's really not there. The markets are designed specifically so that there cannot be oversold, overbought. We had a person come to a tutorial who said, Bill, you're absolutely crazy. There is such a thing. And I said, how do you know? And he says, because they have an oscillator for it. And how can they have an oscillator for it if it's not really there? And so we had to spend a little bit more time with him to explain it. But that's really true. There is no such thing as oversold, overbought. The markets are designed specifically to make sure that that doesn't happen. So we can simplify it that way. We can also simplify a lot of money management that you read. And one of the things that's very common, particularly with new traders, is that they will tell you as soon as you call the broker, the same telephone call, don't hang up the phone, when you put in the order, you put in what else? A stop, right. And they'll say, well, if you're trading the bonds, put your stop in $500 away. Don't ever take more than a $500 risk in the bonds. And if you do, that's okay, but you need to understand that you have nothing to do with the market. You're not trading the market, you're trading your wallet. And one of the most inappropriate questions, in our opinion, that you could ask at the end of the day in trading is, did we make money today? That's totally irrelevant from our point of view. The only question that is legal at the end of a trading day is, was I in tune with the market? If you're using a $500 stop, you're not in tune with the market, because you're trading your bank account and you're trading your wallet. And one of the problems that really gets us, and we're going to get into how to use this very shortly, but before we do, we need to look at the maps that we use for trading. And one of the problems in technical analysis, and let me state quite frankly my opinion, and this is my opinion, technical analysis does not work. I don't know how in the world anybody can espouse technical analysis when 90% of all the technical analysts lose money consistently. Now, if you were a plastic surgeon and 90% of your patients were uglier than when you started on them, you're not going to be in business very long. Technical analysis is not bad, it just doesn't work. And here's the reason it doesn't work. What happens is you have these smart people coming in, the top 10% IQ, and they come into the market, they've been successful in most everything they've ever done. They try to trade, or they start trading, and they lose money. Then what do we do? Well, we pull out the charts and we say, well, yesterday or last week or last month or last year, if I'd done this and this and this, I would have made a lot of money. So they said, okay, if I would continue to do this, maybe I'll make a lot of money. They go to the past and they make a template of the past, and then they try to fit that template onto the future. Unfortunately, it doesn't work. As a matter of fact, the better it worked in the past, the more for sure it's not going to work in the future. The underlying assumption is not accurate. It's a false underlying assumption. And that underlying assumption is that the future will be like the past. And if there's any one thing I have learned in 36 years of trading, is that the future is not going to be like the past. The S&P is not what it was a year ago. And my conclusion is not going to be next year what it is this year. The currencies last year were crazy, wild, and wonderful to us. The currencies are good to us this year, but they're not crazy, wild, and wonderful to us this year. So the underlying assumption behind technical analysis, again, in our opinion, is false. We're using the wrong map. It's exactly the same thing, and right now as we're talking, there's a very, very good football game, college football game going on between number 2 and number 4. So we will cut this short so we can go to the football game later. But it's like playing a football game where you outline every play you're going to make during the whole game before the game starts. Now, how successful do you think a football team would be that way? Wouldn't be successful at all. No, you'd be kicking at the wrong time, throwing at the wrong time. But that's what technical analysis does. It takes this template from the past and tries to impose it on the future. And it doesn't work. It lucks out every now and then, but it doesn't work. So what we're doing as a group of traders, the 90% of us that lose, is that we're using the wrong map. And let me explain what I mean by that. About 22 years ago, a university in Texas did a research study. Now, this is a little bit weird research study. They spent $3 million on this, and they asked 2 questions. If all of the animals in the world had the same intelligence that human beings have, but they had the same physiology. So a grasshopper is still a grasshopper here, but it has the brains of a human. And a cow is still a cow, but it has the brains of a human. And all of the animals at once went out to look for water, search for water. What would be the first animals to find it, and what would be the last animals? Now, all of these real smart professors and researchers could not decide on what animal would be the first. But do you have any idea what? They all agreed unanimously, without one exception, what animal would be the last to find water? Anybody? Fish. Fish would be the last to find water because fish don't know anything else. I mean, you're sitting here and I'm up here, and what we think normally is there's nothing between us, right? But there's a whole ocean of stuff that's going on between us. And just as the fish they can't see the water or don't notice the water, we don't notice what's going on. And this is because of the classical scientific heritage we have. What's going to kill you and I, what we're going to die of if we don't get in an accident or have some tragic disease, we're going to die of gravity. Gravity is going to kill us in the end. And we don't ever talk about gravity, do we? But we talk about the weather all the time. Now, what if we were out of gravity for, say, 2 or 3 minutes every 24 hours? We wouldn't talk about the weather. We talk about gravity. Where'd you go last night? Well, I went to Mars and then came back to Venus and, went around here. But we don't talk about gravity because it doesn't change. We talk about the weather because it changes. We talk about the market because it's changing. The market is exciting because it changes. We live in a logic ocean, and what we think about determines how we trade. And one of the assumptions that we operate under when we trade, and one of the assumptions that I think is true, is that you don't trade the market, I don't trade the market, the institutions don't trade the market, none of us trade the market. We all trade our personal belief systems. And chaos, when we talk about chaos, we'll understand how this affects our trading. Now, our current logic system came down from an old guy about 2,500 years ago by the name of Aristotle. And Aristotle seduced the whole world by saying if you don't know something, the best thing you can do is to go to somebody who knows more than you and ask them. Now that sounds very logical, doesn't it? I mean, all of our society is built on that. Medicine is built on that with its double-blind studies. Law is built on that with its precedents and what cases we had before. And schools are certainly built on that. Right? You go to school to let somebody tell you you're either right or wrong. Right? And you want to get more right, so you change everything to please the teacher. If you're a freshman in college, you're probably very ignorant, and when the history professor tells you to go home and read 10 pages, like an idiot, you go home and read 10 pages. Then you become a sophomore and somebody clues you in. You don't study the books, you study the professors. You give the professors what they want, and that's how you get by. And what you do is you lose your own thinking and you lose your own creativity. Well, Aristotle came down through the ages with this, and his picture of the world was a very smooth running world. And anything that didn't fit in this picture was either a measurement error or it was random. There was another guy who lived at the same time as Aristotle, and I don't know how many of you have ever heard of his name, but his name was Heraclitus. Heraclitus had a very different view. The most famous saying of Heraclitus probably is that you can't step in the same river twice. And Heraclitus had a student by the name of Cleitus who went further than that. Heraclitus says when you step in the river and pull your foot out and you go right back in, not only has the river changed, but your foot is changed also. Cleitus, his student, went further than that. Cleitus says you can't step in the same river once. That in the process of stepping in it, it changes. So on the one side we have this smooth running Euclidean Newtonian world, and on the other side we have this Heraclitean world. Everything goes very smoothly through Galileo, Descartes, all of these people, Newton, and comes down to about 1911, and some little short guy comes out of the woodwork and upsets the whole apple cart. And his name was Einstein. And he came in and he introduced a concept called relativity, the special theory and the general theory. Up to that time, science, classical science, said there are four things we're working with. We're working with mass, energy, space, and time. And Einstein said, space and time are really the same thing, guys. There's no difference. And any self-respecting physicist in the last 90 years doesn't mention the word time without a hyphen in space, or space with a hyphen in time. And he said that energy and mass are really interchangeable. So he took all of this stuff that we'd counted on for all these centuries and eons and took them away from us. The only thing he really left us with as a constant was the speed of light. And then comes along quantum mechanics. And quantum mechanics says, hey, that's no limitation. There are dozens and dozens of things that travel faster than the speed of light. And now we're sort of left with nothing. And John Bell comes in 1964 with what's known now as the Bell theorem, which says that there is no locality of causes, that there isn't a cause and effect, a stimulus response that we all learned in school, that everything is connected to everything else, that you and I are connected. Right now, you and I have been intimate with each other already because you've breathed out part of your body and breathed in part of mine, and we don't notice it, but we've been very, very intimate with each other already since we've been in this room. And John Bell says that we are all connected together. Then, after that, a guy who just passed away a couple of years ago, David Bohm. In my opinion, 100 years from now, people are going to look back and they're going to say the most famous person, world-changing person in the entire 20th century was a scientist by the name of David Bohm. David Bohm was an American. He was a graduate student of Einstein's at Princeton. He was Einstein's favorite student of all, and got somehow messed up in the McCarthy hearings in the 50s and said, I will not live in a country that acts like this, moved to London, became a physics professor at the University of London, and he went further than Bell. What David Bohm said is that everything not only is connected, but everything is the same thing. And that has some far-reaching aspects. It means that you and I and the market are the same thing. That the market is not one of these big economic, fundamental, mechanical or technical kind of operations. The market is really a composite of all these millions of human traders like you and I who are making these crazy, chaotic decisions in our life.
This was just the first part of a fascinating lecture by Bill Williams, a pioneer in trading psychology and one of the earliest voices to challenge traditional technical analysis. At one point, he references a man who passed away just a few years ago, David Bohm. In Bill's view, 100 years from now, people will look back and recognize Bohm as the most influential, world-changing figure of the 20th century. Bohm was an American physicist, a favorite student of Einstein at Princeton. After becoming disillusioned with the US during the McCarthy hearings in the 1950s, Bohm moved to London, where he taught physics at the University of London. But he didn't stop there. He went beyond the boundaries of conventional science. Bohm proposed that everything in the universe is not only connected, but actually the same thing. That idea has profound implications. It means that you, me, and the market are not separate. The market isn't some cold external machine driven by economic laws. It's a living reflection of millions of human traders, each reacting to their own beliefs, biases, and chaos. Through this lens, Bill Williams flips the entire trading paradigm on its head. The market isn't just a chart, a trend line, or a setup. It's a mirror of our thinking, our fears, and our patterns. He doesn't just challenge our tools, he questions the very mental models we use to navigate the market. And this is only the beginning. In the next part of this mind-expanding session, we'll go even deeper into the fractal nature of price action and how chaos theory might be the closest thing traders have to a real holy grail. So stay tuned, because what comes next might just change the way you see the market forever. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.